G'day guys, and welcome to another episode of the Aussie Dividend Machine. In this episode, I wanted to talk about ETFs. This is a beginner's guide to ETFs, explaining what they are and how they could work for you in your investment portfolio. I'll go over their benefits, the different types of ETFs you can own, a comparison to other similar types of investments, and go over whether or not I'll be making any ETF purchases in my own ASX portfolio. I've got friends who absolutely swear by ETFs, and that's the only type of stock they own. So what exactly are exchange traded funds, or ETFs for short? They are funds that purchase a wide variety of stocks within the market, trying to cover all bases. This means they purchase blue chip stocks, small cap stocks, and everything else in between. ETFs provide broad diversification to those who purchase those stocks. Now this can be good and bad, and I'll get to that later in the video. Essentially, ETFs provide access to the market at a low price point and cover a wide variety of stocks, giving you great diversification in the market. They are especially good for people who are not interested in going through each individual stock on the stock market and determining which are good companies and which are bad companies. By having this wide market coverage, they aim to track the index. In other words, this means they try to follow the market return over the long term. I believe it's a great way to get started investing, but there's a lot you need to know before you make your first purchase. So keep watching to find out more. So let's get right into the benefits of ETFs. They have low management fees, they have good returns, tracking the market index, and they're very easily accessible. Once you have a broker account set up, it's as easy as purchasing any other stock. ETFs track the market return, which over the last 20, 30, 50 years has been pretty good. I'll put up the market returns over those years up on the screen just here. The second thing that ETFs offer are really low management fees. Now these fees are really low compared to your traditional managed funds. Those funds that can be found on the stock market, but also funds such as your superannuation or whatever retirement scheme you might have in your country. The low fees are the result of not having to hire a superstar portfolio manager. ETF funds can get away with this because they purchase all the stocks or the vast majority of stocks in a particular market or segment. On the other hand, a managed fund is trying to outperform the market. This means the portfolio managers need to select stocks that they believe will get a better return than the market average. This, of course, comes at a price. Not only this, but a number of managed funds don't even achieve the kind of returns that ETFs do. So, how do ETFs compare to other similar investments available on the stock market and also other ones that are not on the market? The closest comparison I could give would be to managed funds. Some managed funds listed on the ASX include AFI, Argo, and there are some others. A managed fund outside the market would be something like your pension fund or your retirement fund, which here in Australia we call your superannuation. These types of funds are not only trying to match the index return, they're trying to outperform it in most scenarios. You may notice in your pension fund or superannuation, there's a number of options in terms of the risk return you can get on your investment. These are normally in 3 tiers. They're growth or high risk, balanced or medium risk, or the more secure conservative type of option. So what are the fees like in ETFs compared to these managed funds that I've just listed? So typically managed funds have a much higher management fee than your typical ETF. Why is this? Well, managed funds employ expert analysts and portfolio managers to try and pick stocks or shares that outperform the market. These people are very experienced, and obviously that comes with a price. This price is passed on to purchasers or those who own managed fund investments, and that's reflected in that management fee. ETFs, on the other hand, because they're broadly diversifying in the market, they're not trying to pick individual winners within the market. As a result, they have portfolio managers who come at a lower cost, and hence that management fee is lower. So just a little disclaimer, guys, whilst ETFs can be great, managed funds do have their place. There are some excellent managed funds listed on the ASX who have performed very well over the long term. So by no means am I discounting their value and their performance. As an example, in Australia, superannuation funds have led to fantastic retirements for a large number of the population. Investing more in your superannuation fund is something I'll cover in a future video because it definitely has its own merits and could be perhaps the type of investment for you. So with that being said, let's go over the benefits of ETFs. They give you wide diversification. They track the market performance, which historically has been excellent. They provide a great way to get started in the market without having to buy into a number of different stocks. Now I wanted to touch on the different types of ETFs that are available on the market. The companies that offer ETFs will differ from country to country. Some of the major providers in Australia are Vanguard, Betashares, and Blackrock with their iShares brand. These companies offer a huge variety of ETFs that continues to grow. It's also interesting when you look into some high-performing companies, you'll notice some of their top shareholders are in fact these ETF funds. When you go looking on a website such as Vanguard's website, you'll notice they have a number of different types of ETFs. These range from tracking the ASX 200, tracking different sectors, and tracking different types of investment performance, whether that's growth or dividend yield or up-and-coming companies. These companies also offer different kinds of funds on the market. These cover investments such as government bonds, treasury bonds, and even corporate bonds. There are even fixed interest rate funds available on the market, which may well have a better interest rate than your current bank account. These are all worth considering, and it will depend what your risk appetite is, and that will influence what type of fund you decide to buy into. Another great feature of ETFs, because they are bought and sold like any other stock in the market, they have high liquidity. So what does liquidity mean? Liquidity means that you can easily transfer your investment into cash. Because ETFs are bought and sold like any other stock on the stock market, within a couple of minutes, you can make a sale and have the cash right in your account. Traditional funds or unlisted investments might have you locked into a certain time period where in that time period you cannot cash out your investment, similar to a term deposit that might be available at a bank. Now, some of these alternative products they offer, such as bonds or fixed interest accounts, may seem a little bit unappealing. However, these types of investments definitely have a place within your portfolio. A lot of investors will tell you to hold a certain percentage of bonds so that in a market crash or a downturn, the bonds typically, because they're secured, hold their value. This means as the value of your other shares fall, the bond price will be stable. This gives you a safe haven during a market crash. It allows you to sell off your bonds and use that money to buy stocks, some of which will be at very heavily discounted prices. The other thing I personally really like about ETFs, whether they're covering bonds or covering the market index, is that they pay a quarterly dividend. Unlike most other shares in Australia, which pay biannual dividends, a quarterly dividend is a great way to get some cash flow happening in your portfolio, especially if you're just starting out and you don't have a wide spread of companies. So for a beginner investor, it makes sense to start with a ETF that covers the broader market, such as a ETF that covers, for example, the ASX 200. This way you get good coverage, you have a large number of stocks under your belt from just a single purchase, and you'll get access to the market performance in general. The reason you might want to start looking at more focus or select ETFs is when you're chasing either stronger returns or you find that one part of the market has a little bit more security and that appeals to you as an investor. To give a quick example of this, I'll put up the performance of the ASX healthcare sector. As you can see, the healthcare sector of the ASX has way outperformed any other sector available on the market. Now, sector to sector performance may differ market to market. However, in Australia, we've got some really good leading healthcare shares. Some of the leading healthcare companies we have in Australia include CSL, which is a company that manufactures blood products. They've had an extremely good track record over the last 10 years. Some other innovative companies that we have in Australia include Cochlear. You may have seen some people who are deaf with a magnet that attaches to the back of their head. That magnet attaches to a device called a cochlear implant. This device greatly improves their hearing, and it was a real breakthrough when it was released. That device is produced by Cochlear, which is an Australian company listed on the ASX. So whilst focusing on an ETF that narrows into a particular sector may result in greater returns, as a result you lose that insurance of having wider exposure. So as you can see, there's a bit of a pyramid forming here of chasing higher returns. So at the bottom of the pyramid is your fixed interest ETFs, your bond ETFs, and similar types of investments. The next step up in the pyramid is your broad diversified ETFs. Going up again, and you get into your specialized ETFs that might track an index, for example, ASX Healthcare, which we've spoken about. And then at the top of the pyramid is going in and selecting individual stocks, picking those particular stocks that in one sector might be outperforming all of the others. It's these investments that see the best returns on the market. Ultimately, it's up to you to decide what level of the pyramid you want to invest on. I'd suggest as your investment knowledge grows and you become more comfortable with understanding the market, you may go up and up the pyramid until you get to the point where you can identify some really strong companies that have great long-term prospects. However, if you're just getting started, I could 100% recommend ETFs as a great way to get good broad exposure in the market. Another disclaimer, guys. I just want to make this really clear. There are no guarantees in the stock market. Any experienced investor will tell you, do not put money in the market that you cannot afford to lose. If you've got money set aside for a house, set aside for college, set aside for an engagement ring, don't put this money in the market. Whilst market returns historically have been good, these are long-term returns. These are returns over 5 years, 10 years, 15 years, and even 20 years. If you're looking to make some quick money over the next 6 months or 1 year, you could be very disappointed, especially if the market takes a downturn. In the long run, all of these ups and downs in the market do eventually even out. That evening out is the long-term market return, which we see around that 8 to 10% mark. For this reason, guys, I think it's really important that you take a long-term position with investing. Don't invest money you can't afford to lose, and don't rush into making decisions. Explore all of your options before investing, and perhaps the stock market's not for you. The stock market certainly isn't the only great investment option out there. For a lot of people, Australians especially, property has been the best investment people have made in their life. That being said, the stock market does present a lot of opportunity once you have all the basics and fundamentals covered. Do you have a property under your belt? Do you have consistent savings? These are all things to consider before you start investing in the stock market, and things you should be comfortable with before making your investment journey. Okay guys, with that said, will I be investing in ETFs going into the future and in my current portfolio that I'm sharing with you guys every week? The answer to that is yes. If you'd like to see my latest portfolio update, make sure you check out my latest video. I'll put a link up on screen now. So what type of ETFs am I personally interested in? Well, because I live in Australia and I've got the most exposure to the ASX, this is the market that I will not be purchasing ETFs in. Because I have an understanding of the ASX and I live and operate in an environment where I can identify stocks in my day-to-day life that I think are good performing companies, I don't see the need to purchase an Australian ETF. The ETFs that I am interested in are the ones that cover overseas markets. In particular, I like those that cover the US stock market and give me access to the earnings of the major tech companies that we simply don't have an equivalent of in Australia. This is your Facebook, Microsoft, Tesla, all of these blue chip technology companies that we simply don't have an equivalent of in Australia. The other type of ETF that interests me personally are ones that cover emerging markets. Emerging markets are those where we can see some really exciting growth from countries that are still developing. This includes Southeast Asian markets, Africa, and parts of South America. I wouldn't even know where to start looking at high-performing companies in those countries. For this reason, ETFs that cover those markets really appeal to me. Maybe you guys watching do know some companies that are really high performers in some of those areas around the world. If that's the case, leave a comment below, let me know what the company is, a little bit about what they do. I'd love to hear about it. So one final point I'd like to raise is determining whether or not a particular ETF is good value or not. You might have decided that ETFs are the right investment type for you, but how do you know what you're buying is good value? Is it overpriced? Is it underpriced? How can you tell? Well, there is a performance metric that gives you an indication of whether or not an ETF is overpriced or underpriced. It looks at the underlying value of the portfolio compared to what its current market price is. This calculation is called the NAV, and I'll leave a link in the description of an article that will explain how they come up with that value far better than I could. So guys, if you have decided ETFs are for you and you're interested in purchasing an ETF on the stock market, make sure you read that article below before making your decision about what ETF exactly you'd like to purchase. So guys, thanks for watching the video. As always, I really enjoyed making this one. Make sure to leave a comment below if you've got any questions. Give the video a thumbs up and subscribe for more investment content.